Hello, everyone. I'm back again. I hope you're doing great. Today is Tuesday, May 12th. I'm recording today a chart chat, but I'm also going to use this as an opportunity to do another quarterly overall market update commentary. And we're going to use this as an opportunity to review the portfolio changes in the champ models that have affected your portfolio. I'm sure by now you've seen trade notifications and that type of thing. So I wanted to outline some of the changes that we're making inside the portfolio. But before I get into that, for anyone and everyone, I wanted to take an opportunity to walk through not only what we're seeing in the markets in this constantly evolving landscape, this very wild and, volatile, but much more sentimentally volatile or emotionally volatile than it is perhaps even in the data or in the the raw mechanism of the market. um Oddly enough, it's showing some robust resiliency despite, again, what everybody kind of feels and senses. So the question becomes, are we getting better or getting worse? That's always the question I like to ask, because that's really what the market cares about. The market is far less interested in the state of affairs in an absolute vacuum. It's simply relative to both recent history and long-term history. Are we in a better trajectory or a worse trajectory? And I'll tell you what, this week is pivotal. There's going to be a lot of information that comes out of this week that isn't the CPI and some of these other factors that, of course, are going to be spouted out by various financial news media, whatever it is. But really, I think the crux of this week is going to rest on the Trump meeting with Xi Jinping in China. So much of what we're seeing geopolitically and globally is going to be impacted by this meeting and the overall stance and the positioning that the two nations, the United States and China, and of course their collective cohorts, sort of how they position around this, and then of course the non directly impacted parties. There's a lot of carry-on effect for everybody else. So with that being said, I'm going to lead off by walking through the kind of the chart chat element here, talk about the markets, and then on the back end of the video, I'm going to append the overview of the portfolios. So if I can edit this right, I'm going to put a timestamp somewhere right around here where if you care to skip forward just to see the portfolio changes, you're more than welcome to. But I would encourage you to hang with me because hopefully I'm going to shed some light on some information that will not only be valuable for you, but most importantly, help you frame expectations as we look at the road ahead. Because if we, again, I reiterate this over and over again, if we set our expectations, the traversing of the landscape that lays out for us is going to be far more navigable, because we have a baseline expectation set, and there's less of a chance of major surprises. So with that being said, let's jump into it. Okay, so before I even bring charts up, one of the first things I want to talk about is sort of a macro outlook on markets, the global economy, and some of the pivotal things that are in the works right now. I mentioned the meeting with Trump and Xi Jinping. That is going to be paramount this week, and it's going to affect the short-term markets, and of course, it's going to help construct a let's say a pathway for the road ahead. On that road ahead, there's going to be some critical, not stopping points, but some critical roadside attractions. Let's use that as our language here. The most pivotal of the roadside attractions is going to be whether or not we get a confirmation of a new Fed chair, Kevin Warsh being the nominee who has been going through the obligatory congressional hearings to potentially confirm him. I want to really hit on what's been going on with that, because I do think it matters tremendously. But it matters because it's going to help us shape our expectations, not because the actual Fed chair matters as much as we think he or she does. But They do matter because the market cares. But going back to Trump and Xi, let me just isolate, I would say, like three main points about why this week becomes critical. One, the United States is to some degree dependent on Middle Eastern oil. And I say to some degree. There's this counter argument that, energy independence, America is energy independent. Careful with that. I've highlighted before in previous videos that the energy independence argument is true. However, the practical energy independence just isn't there. The crude product that we have here in America and with our immediate allies that are geographically located close to us, not as robust as we might want it to be. Natural gas, we have tremendous resources. We don't have a natural gas driven economy yet. I think it will probably end up that way eventually. Natural gas combined with a couple of other, perhaps we're going to finally see nuclear really come online in an effective and efficient manner. But why I want to parse these details out is the crude products that are derived from the Middle East, they are really the efficient modalities for things like refined oil products like diesel, marine oil, heavy marine oil, heavy marine diesel. A lot of the industrial fueling is derived from the crude products that we see in the Middle East. So the Strait of Hormuz matters for the US, but it doesn't matter nearly as much as it does for China. So with that, the kind of linchpin in this whole thing, or the cotter pin, I would say, is the fact that China wants the straits to be flowing easier. There are vested interest parties in the Middle East that would align themselves or ally themselves with America on paper or politically speaking. But at the end of the day, they like having China as a buyer of their product. Therefore, they want the straits opened up and not impacted by whatever conflict is going on. To take that a step further, China not only wants it, but China has a very critical piece that they can, a button, let's say, that they can press if they would like to insist that things open up, and that is Taiwan. Taiwan was front and center in everybody's imagination, minds, headlines, whatever it was, not that long ago, less than a year ago. However, it fell to the wayside, but that is a major piece in this puzzle. The United States has been working very aggressively, the Trump administration, his cadre of, dare I say, oligarchs. They're moving very aggressively to try to reshore to a degree, not necessarily domestically here in the United States, but regionally in the greater Americas, reshoring the manufacturing, production, and the facilitation of production of semiconductors and all things that basically are fueling the US economy. Whether they should or shouldn't is a whole different story. But the reality is that this major AI infrastructure project that we're seeing, where we're getting these arguments around data centers and we're getting, all this hubbub and hype and everything else. The markets, of course, semiconductors, GPU manufacturers like NVIDIA, CPU manufacturers like Seagate and Western Digital, and then, of course, the infrastructure, physical components, manufacturing. So much of that is actually in Taiwan. Taiwan Semiconductor is a great standout. Doesn't mean all, but a lot of it is. And there's been this clear effort to reshore that back to the US, or potentially leverage allies like Japan and Korea, where there's a regional reshoring to a degree, right? It's just the Pacific Ocean cross rather than the Atlantic Ocean cross. But there's no Middle Eastern conflict involved, and it kind of isolates China and Russia to a degree. They're not in between, the U.S. and Japan, let's say, or Korea. The argument would be the same for Taiwan, but the problem is that China has made it very clear that they want to kind of reabsorb Taiwan. Now, why I mention that is, if things come to the table and Trump is playing hardball, I can assure you Xi's ace up his sleeve is going to be Taiwan. He's going to tell Trump very clearly, if you don't open things up, we're taking Taiwan. And this is why it matters for Trump, is because the reality is, and I'm probably speaking a little bit out of turn here. I have it on pretty good record that, and we've seen it publicized in news media, but I don't trust any of that reporting. But the reality is that from a military perspective, we're not exactly, busting at the seams with military excess. I'm choosing my words very selectively here. I don't want to be misinterpreted because I don't have full conclusive evidence of anything. What I can say though is we've used a ton of munitions, we've used a ton of resources, we've exhausted a lot of our reserves in both Ukraine and in Iran, for good, for better or worse, depending on which side of that aisle you're on. Let's leave that conversation separate. The reality is though is that the manufacturing capacity to replace and replenish those somewhat limited. Okay. To go a step further, China goes and takes Taiwan. The worst possible thing that could happen for the US is that the military might of the US gets called into extreme question because we get pulled into two different fronts. Even if we're just kind of in these proxy situations like they profess we are supposedly with Iran, right? It's not a hot war, or it's not boots on the ground war, or it's it's a bunch of language more than anything. But that's going to be the ace up his sleeve that Xi pulls out. Trump does not want that to happen. I can assure you that. Why does that matter for markets? Well, it is a very, very tenuous subject as it relates to the main drivers of our markets right now. The things that are making the market so robust are the same things that had been taking a bit of a breather, a bit of a break. Back in quarter one, I was talking about the rotation out of the semiconductor space. Well, the reason that it's rotated back into the semiconductor slash AI slash whatever is the fact that as this war, as Iran, as it's been digested by the market, whether it's been accepted or the fears around the war aren't necessarily abating, but because it's not new anymore, right? We sort of fall into this lull. But then at the same time, that is the so-called future of both the war. It's the future of the homeland security, also known as the surveillance state, and the technocratic disaster that we are currently creating for ourselves. It's a bit of editorializing on my part, and I apologize for including that, but I do think that it is relevant because that is where the hopes, dreams, and expectations of the market are refocusing. If Taiwan comes into question, this is going to be a rug pull situation, the likes of which we don't really know how to uh, forecast. No one can, because it will disrupt the entire market. You think oil, don't get me wrong, oil very much disrupts the global economy. But a rug pull in the semiconductor space right now will be very disruptive, specifically to the US economy and to the US. Yeah, because using the word economy is not even fair. It's not appropriate. But the US markets, let's just leave it there. Okay, we'll just step back from it, leave it there. I don't think that's going to happen. However, that is definitely something that we have to watch for. Now, let's take it a step further. Let's kind of work our way down the road here. One of the other big pieces, and this is going to play into that road stop, or that roadside attraction that I mentioned a moment ago. One of the other big pieces in the big puzzle, the geopolitical puzzle, but the market puzzle, is the fact that China used to be the big buyer of US bonds. We've talked about this ad nauseum. I'm not going to bring it back up. I encourage you, please go watch any of my previous videos. I'm sure that I touched on it in virtually every video. But the reality is that yes, China has been selling the US debt as their safe haven for their sovereign wealth, or their parking money in US debt. In turn, the US buys a bunch of products from China. And there was sort of a, I scratch my back, you scratch my back, I scratch your back sort of relationship. And that's been digressing, um, for good or bad reason. Again, let's leave that for a different day. The point is, it is what it is. We are definitely seeing China continuing to posture itself as another currency for trade. There's plenty of other countries. I mentioned another video that India, did a deal basically in the yuan or the Chinese currency for oil. That was a big deal. Slid right under the radar, still hasn't gotten a lot of coverage. Notably, there were some very interesting geopolitical related events that recently just occurred in India. If you're interested, please go look at what Narendra, let's just call it Modi, the India's president, for lack of a better word. He made a fairly controversial speech just a couple days ago, encouraging Indians to not basically buy gold, not to send the rupee out of India, keep it inside, buy Indian goods. It was a very nationalistic toned speech, and it sent the Indian markets into a bit of a tizzy. The reason I mention that though is India's big country in terms of population, and they're kind of not really sure which side they're going to pick. They claim to be very pro America, but the reality is China's geographically very close, and you know it could go both ways. Okay, let's put a pin in that, leave that for another time. To go back to the main point though, is when we're looking at China is posturing and positioning for continued currency strength and trade strength without the United States. That's going to be something that Trump is trying to soothe. I don't think he wants to reverse it. I think he wants to soothe it. Because at the end of the day, the only way Trump can continue doing what he is doing in his administration, because Trump is but a mere puppet in a grand scheme of various interested parties that are all collectively bargaining for getting the most, as with any geopolitical, it's always been the case. But to be like, oh, it's just this one guy, stop with that. Right? Don't be so infantile. It's that one guy, certainly, and all these other parties that are vying for push and sway and control and whatever else it might be. Most of them probably allied in some ways, shapes, or forms, most of which we don't necessarily fully understand. But Trump is looking to make sure that the dollar doesn't lose its status at a precipitous rate, and that there are other countries interested in continuing to park their safe money in the dollar by way of treasuries, because you can't continue the game that he's playing, which is effectively the opposite of what he said he was going to do when he campaigned, right? But you can't continue doing it unless somebody's buying the debt, because the debt isn't going down, okay? So that will be a bargaining chip that Trump brings to the table, where he can say, I'll open the straits, you need to buy more treasuries. Does China want to? No. Will China? Probably, because they'll play the long game, because that's what China does. China has also backstopped so much of their currency with the continued gold purchasing that they're doing, not to mention mining, not to mention the excess refining. So the moral of the story here is that both sides actually have some viable weight that they bring to the table, but China is going to be the one asking. Trump is going to be the one conceding in this meeting. The question is, how much does he concede? And that will then dictate what happens next. So, a lot to be seen there. I would say that markets are less sure of this meeting than we would like for them to be in a, let's say, perfect world, but you're starting to already see that. Today, for example, yesterday we had this hot run up, which is probably a bit of a blow off top near term, but a sharp run up in semiconductors and in the tech space and in, the market as a whole, like broadly speaking. But that was quickly quelled, and the news cycle's telling us, oh, it's because tensions are rising in Iran. And that's not to say they aren't. They are, and they will continue to rise, mainly because of the meeting that's going on this week with Trump and Xi. Okay. Moving on. Next step, that road stop that roadside stop. Okay, I mentioned China needing to buy some treasury, getting back into the treasury market, and the net impact of that. The next piece of the puzzle goes to the rate market and the interest rate market, and this is where we're going to start talking a bit more about charts, markets, etc. But before we do, I want to quickly talk about Kevin Warsh. I've talked about him already. I have mentioned his coincidental affiliations and associations. I do not think it can nor should be overlooked that he has direct familial ties to Ron Lauder of the Estee Lauder family. I don't care so much about that part. I care much more about who Ron Lauder has been and is in the greater geopolitical network. Ron Lauder, without any doubt in my, and this is just in the documents, but very connected to multiple parties named in the you-know-what files with a you-know-who that seems to all be but forgotten. But Ron Lauder is the president of, or has been, and I believe since like 82 or 83. I think it's technically called the World Jewish Congress. But the reason that matters is because, of course, Israel is front and center in the Middle Eastern landscape as it relates to what's going on right now, as it relates to Trump. You have to just accept that. People get nervous about it because they don't want to be called this or that name, or, oh, you're an anti this, or you're a what. Look, I don't. I for the sake of our argument in understanding the landscape of the road ahead, don't get your undies in a bunch. Just be practical, pragmatic, and logical about this. Having the son-in-law of the president of the World Jewish Congress, who has been vocal lately about waning support for Israel and you can't change people's mind and the propaganda wars and all that. Look, you can call it propaganda wars or you can call it dissemination and democratization of hidden history, whichever one. But the reality is there's dirt coming out of the closet left and right with Israel right now, whether it's been used conditionally to try to sway opinion or not. I would absolutely argue it probably has been. But the fact is that there's a ton of dirt that continues to come out about Israel, and that is creating a waning support for Israel. The same Israel who is our greatest ally, blah, 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 but also the one who has a vested interest in pushing more war in Iran. Also pushing more spending to support Israel. How can the U.S. spend more to support Israel? Well, they can't do it taking on more debt and taking on more debt at higher rates. But, my friends, there's a big problem. You can't just cut rates right now. Or maybe you can. Here's why you can't cut rates really without totally cannibalizing the United States. If you cut rates now, the inflation pop that will basically happen because it is so primed and so ready to go. It's like a balloon that has been filled with water to the absolute seam and it is just a matter of chill, calm down, don't burst. But the inflationary problem is very much here. The reason it seems that there is such an emphasis on the AI modality, the AI, I don't have the right language for it, but AI as an investment thesis is it is theoretically disinflationary, but it's also, for lack of a better word, the opposite of an industrial economy. An industrial economy, by our historical standards, requires a employment base. AI does not. So it is somewhat anti-inflationary or disinflationary by theory. So if inflation goes up, it's okay because you don't have to pay workers more. You've got AI. What does that mean for our economy as a whole? It's not good at all. The point is, cutting rates right now will create an inflationary, hyperinflationary boom that will then inevitably lead to stagflation because the wages won't be able to match the inflationary pressures. We don't have enough domestic production capability or capacity. So there's a problem here. Now, let's go to the charts to fill in the blanks on this story. All right. So let's kick it off with this particular headline. I think that this is it's a good jumping off spot to continue our conversation around Kevin Warsh, but to talk about the inflation decision or the rate decision, because that is a pivotal point in understanding again the trajectory of markets, but it's also let me make sure I reiterate, being of the Austrian school, being a avid and firm believer that the Federal Reserve is one of the greatest drags on, and this is central banking at large, but specifically the Federal Reserve because of its power. It's a tremendous destroyer of all things middle class and down, even upper middle class and down. They are the greatest wealth transfer tool out there. But without being able to abolish the Federal Reserve at large, which I would love to do, that isn't happening right now. Okay, definitely not right now. In fact, I would argue that the Federal Reserve's position in the world, or at least in the domestic markets, is probably going to grow in the near future. But you'll see here, Kevin Warsh gave his preferred way for measuring inflation. It could come back to bite it. All right, CNBC, it sounds like a nice clickbaity headline title. Okay, what are they talking about though? All right, so in his, I believe it was the Senate hearings, Warsh brought up the fact that he prefers a so there's a PCE inflator, there's a PCE deflator, there's CPI, there's okay, fun acronyms, great, wonderful. Unless you're, taking a 101 in economics, you probably never really cared much about these things. But there are a million ways in reality to measure inflation. Okay. A lot of economists don't even agree on what inflation is. Okay. I know that many will disagree with me, but the hard truth of it is, if you boil it down to first principles, inflation is nothing more than less of a, let's call it a money or a value attributed modus of contractual obligations. I don't know. I'm trying to come up with something fun. Basically, if you're trying to transact in a thing, whether it's seashells or beads or cotton paper or something else, if there's more of that thing and less stuff to buy or less services to buy or less things that you're going to transact for, you're going to get inflation. More money chasing less goods and services. That's plain and simple what it is. Okay. But measuring it all of a sudden becomes, well, what do we measure? Do we measure things that have high variability or high price elasticity, meaning they can fluctuate in price quite a bit before the consumer sort of steps away from them? Or price inelasticity, meaning the price really can't change too much. Before you start to get a major fall off in the demand. But Kevin Warsh made it very clear that, and that it's very convenient, he prefers a trimmed mean PCE. What does that mean? Well, let's go over here to a chart. Okay, here's our trimmed mean PCE inflation rate. Now, before you derive too much information, just note this is a monthly chart taking us all the way back to 1978, give or take. Okay. Now, you'll notice this thing, generally speaking, has a downward trajectory. Now, in history, recent history, The Fed has basically said we don't really care that much about CPI in general, which is the consumer price index. Now, a consumer price index, for sake of comparison, let's take this consumer price index for all urban consumers. Now, what is this showing us? Okay, it's a monthly chart. Boy, that's ugly. This right here is visualized the thing that you're so used to hearing, the 5-cent cheeseburger from 19 whatever, now it costs $10. Or if you're, oh, let's go use the inflation calculator to see what it costs in today's dollars, right? This is what it looks like visually represented. This is consumer price index. So this is taking effectively all goods and services, aggregating them out. And I'm oversimplifying the definition. It's actually much more specific in terms of how it's calculated. But this is governmentally calculated. There are some independent calculations that would make this look like you know, a kiddie ride, not this very steep ascent that it looks like, because this is even selective in what it measures. But you take that and you say, okay, well, what is it year over year, right? Let's just look at the rate of change, because we know that inflation just goes up forever, so long as we have a central bank, okay? So long as we have fiat currency, so long as we have all the factors that we currently exist with, and people think, oh, you're the crazy guy who likes to talk about these things. No, no, no. I'm the guy who lives rooted in nature and history. And I realize how artificial our current financial construct really is, but it is what we're operating in. So while I can bemoan its faults and fallacies all day long, it is what we have to operate in. Therefore, if we look at this in terms of the year over year change, you'll notice most recently in history, when I zoom in here, right, here's our 2020 event, right? Here's our July of 2020. Or rather, May of 2020 is kind of where we hit our low, and that was the extreme lockdown. And then all of a sudden, the stimuli of various sorts, all of which stupid and asinine beyond belief, perhaps intentionally so. This is the inflation problem that we created leading up into, basically September, when all of a sudden of 22, where, oh, we magically now have stopped printing money. We have been raising rates, yeah, and now inflation is not going to be a problem anymore. Not true. But that was the argument presented by the Fed. Okay, and then of course, yes, the year over year rate of change, right, has declined. But round about the middle of last year, no, it hasn't declined. Now, just for sake of argument, then we're going to get back to Kevin Warsh's favorite PCE, trimmed mean PCE. But I'm just going to highlight this chart. This is the M2 money supply, the money stock. This is the amount of money chasing the goods and services. The one I mentioned a minute ago, that's when there's more money chasing the less or same goods and services, you get inflation. Now, this isn't to say that we don't have goods and services being produced. We do. So to take this absolute and be like, look, it's going back up, we're going to have major. No, 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 no. Don't misinterpret this. But the point is that notice kind of where we are here. June, we kind of had this first dip low. April of 23, we kind of had a low lull going into January, February, March 24. And since then, the money supply has been expanding again. So going back to that CPI year over year, here we are in March of 20. So this flattening period here is where we started to produce more money again. We were not contracting the money supply, we were expanding the money supply. And then, of course, we get this last final dip, and that was because of the tariffs. All of a sudden, it was like, oh, it's okay, everything's going to be okay, right? Because the US now all of a sudden has protectionism or protectionist policy in place. But then it didn't, because certain tariffs were suspended, et cetera, et cetera, et cetera. So now all of a sudden, we're back to the same problem. Now, you'll notice CPI year over year, look at that, it's going up. Raw CPI over time, it's going up. But look at what happens when we start to look at the trimmed mean PCE inflation rate. Oh, how convenient. It's still going down. Now, why on earth would a new Fed chair, who, mind you, just a quick refresher, the whole reason when he was submitted as the nominee by Trump at the end of January, currency metals markets took a nosedive because he was going to be this hawkish, very aggressive Fed chair who was going to liquidate assets off the Federal Reserve balance sheet. He was going to raise rates. But now he's the one that prefers the the inflation indicator that's showing that we're not getting inflation. I wonder why he would do that. Why would he do such a thing? Okay, I'm being overly sarcastic here because I have such disdain for these folks. But the reality is this is what's called posturing, right? That's what the Fed does best, and the Fed is currently posturing to set itself up to allow it to cut rates. That will not be a permanent thing, but I can assure you, as we go through this week, leaving Trump and Xi, pretty good news will probably come out of it. Oil, those kinds of things, probably going to be peaking out about right now. Because what we're going to see is, assuming Warsh gets confirmed, and I do think he probably will, we may even have one more rate decision by Jerome Powell in the summer, but we might get an intervening rate decision or an early fall decision where we see a rate cut. Now, that cut is not going to be sustainable. Again, unless you want to completely cannibalize the US economy, which you very well may. But if the war in Iran continues on, so this is going to bring full circle back the whole Ron Lauder part of it. Kevin Warsh is tied into a very select group of people who certainly have his ear. And he's going to be pushed very aggressively, even if it's not the president, which it's going to be coming from the president. But remember, the Federal Reserve's an independent, private. Okay, fine. Sure. And they're also apolitical, says the same Federal Reserve who, for the past, like, I don't know, 8 to 10 years, has been all about the DEI initiatives and what the right calls woke culture. All of a sudden the Federal Reserve was like championing this garbage. And I'm not saying that from the pro-right angle. I'm saying it's garbage because the Federal Reserve shouldn't. It's not their damn business. But they were championing, but they're apolitical, right? Yet now all of a sudden they have nothing to do with it whatsoever, just completely off the books. But I'm sure that they're independent and apolitical. No, they're not. That's the point. They're not. Okay. So we're going into election time. Economic well-being, no pun intended, trumps or supersedes social issues, virtually everything else when it comes to election time. If the economy is running well, people tend to vote in favor of parties currently in control. The incumbents get voted in. It's just what happens. If the Federal Reserve wants to, let's say there's three things that those who have Kevin Warsh's ear are going to be pushing him to do. One, make sure that Israel continues to be funded because the war in Iran will not stop because they haven't gotten what they wanted yet. Otherwise, they would quit invading Lebanon. They would quit the nonsense in Gaza, but that didn't stop him. Okay, they have not got what they want. Okay, they also need the US economy to buy their products, which is why many states have, you can't ban, you basically don't get federal contracts and you can potentially be penalized criminally, if I'm not mistaken. It's not just civil, but there's criminal penalty for boycotting Israel, like, and there's speech laws around. I mean, come on, it's repulsive. But while I think it's repulsive, the takeaway is this is a country that has the US, at least politically, in a bit of a bind. So that will be one angle, is making sure that the funding to Israel continues. Okay. fighting on behalf of Israel probably will continue. The only way that happens is if you cut rates, because we can't issue new debt at higher rates because the US economy cannot sustain the interest rates on the outstanding debt as it is, let alone new debt where they're rolling old debt over into new debt. The old debt that's rolling over, let's say 10-year, think about 10-year notes from 10 years ago, right? Those were at precipitously low rates, excessively low rates relative to where we are today even. And if that were to go up, we cannot sustain because our debt load, the carry cost of our debt is already in excess of what we spend militarily. So if you kind of see how the puzzle pieces are coming together here, the Ron Lauder father-in-law, I mean, it's bad enough to have a pain in the butt father-in-law, but to have a pain in the butt father-in-law who has a vested, very clear tie directly to some of the biggest players for the other country that the US is allied with, greatest ally, blah, blah. Okay. So you got that angle coming in. You've got the domestic angle, which is we want elections, right? The current, you know, population of politicians boost the economy before the election so we get reelected, right? That's unfortunately what our politicians do now because of where we are in the stage of so-called democratic republic that we want to think ourselves to be in. Okay, so they're buying that. And then the third piece of the puzzle comes into where we are with China. And this goes back to where Trump is right now with China. Because if you think about it, the rest of the world, interest rates wise, generally speaking, the rest of the world's looking back at the United States and they're looking at China and they're like, all right, is China going to go and buy the US debt? Let's say that's the deal Xi makes. Xi Jinping says, all right, you open Straits of Hormuz, you let the oil flow freely, you just get out of our way. We'll come and buy some of your debt. The rate environment is also going to dictate whether or not China has any interest. And then, of course, other countries have any interest in buying back into the US debt because at the same time, they're not stupid and they know the US can't sustain higher rates. So they'll probably say, okay, but you don't raise rates because if you do, we're not going to get paid back because you're not going to be able to handle it. Trump can say, fine, we got our man on the job. He's about to be confirmed. Okay. Is this good? No, it's not good. Okay. But does it help lay out what is likely to happen? As of right now, that is the likely trajectory. It doesn't hurt that with Jerome Powell, the current Fed chair, in his place as he is, this most recent Fed meeting, this decision meeting that 2 weeks ago, this was the largest dissent vote by the Board of Governors, because again, it's not just the chair of the Federal Reserve that sets the rates. It is voted on by a Board of Governors who can very much be politically encouraged, to use fluffy terms. Okay. But they had the highest dissenting vote rate on the rate decision since 1992, I think. Could be off on that date, but I believe it's 1992. All right. The largest dissent vote. Those dissenting votes were all in favor of lowering rates, cutting rates. The Fed Board of Governors is ready to do it. Does our economy need it? Yeah, like consumers absolutely need lower rates. Absolutely. Does the inflation problem need it? No. So the only counter argument that you can currently pose is that deflationary or disinflationary angle around AI. Okay, this is a two-edged sword, but okay, maybe it is disinflationary just by virtue of what it is. It's probably not, at least not in the near term. But take that argument, fine. Okay. Oh, well, look at this great disinflationary pressure that we've got because AI is making things cheaper and more affordable and more available and blah. But it's also displacing workers. So incomes decline. Okay. Which means they can't afford the things that are getting more expensive because of inflation. See where I'm going with this? Okay, so we're in the midst of watching this problem become it's funneling into a place where what happens next? Look, I've been amazed by how long this can get kicked down the road for basically my whole adult life. I think it's phenomenal. I hate it, hate every bit of it, because a natural market requires resetting. If the government just comes in and pumps money into every little problem, you don't get a natural organic market where you have buyers and sellers coming to a table and agreeing on price and overvaluation, undervaluation. You don't get appropriate pricing, you just get inflation. And then, of course, you get a middle class that gets completely gutted. You get a wealth transfer problem that is the likes of which we really haven't seen until, or unless you look at certain empires that aren't around anymore. But this isn't doom and gloom. This is to say, as the trajectory that we're currently on continues, the, we're going to continue the problem, but things can change. And I do believe they will change because I think the market will mandate that they change. But in the meantime, if you're planning on lower rates, the planning mind that I have as of right now, the trajectory that we're on, the weight of the evidence would suggest we very well might get a blip in lower rates on the short end of the spectrum sometime between now and November, probably in late summer, because we will get an economic slowdown, most likely, because things tense, volatility affecting matters will ramp up as we move into the summer months. Okay. Whether it's war, I don't know what it's going to be. But I think that there will be heightened tensions, heightened volatility as we lead into summer. Then all of a sudden that will give them the excuse to cut rates because, well, look, markets are down, not by necessarily much or anything, but then they'll overstimulate the short-term memory span of the average voter will say, oh, look, like markets are up a whole bunch day after day after day as rate cut settles into the market. We'll get through election time, depending on the outcome, of course, anything's possible. But by then, the inflation problem, this trimmed mean PCE inflation rate, is going to shoot up. And then all of a sudden, we're going to have higher rates. So if you're in that position where you're saying, I'm counting on being able to refinance, I'm counting on lower rates, a lot of people have deluded themselves into thinking that's a possibility. I would argue with you, if it's going to happen, it's going to happen, near term. Be ready. But I will also suggest to you, it's probably not going to be as impactful on the long end of the lending curve as you might think. So if you're in that 30-year mortgage world, I don't think you're going to get the cut that you think you're hoping for. I've anecdotally I've spoken to several potential clients, people just in the community, friends, they've mentioned, oh yeah, it's going to be down, when it's down to like 5, sometime in the next year or so, I'm going to refinance my house. I would not put all my eggs in that basket. If we were to look right now, okay, here's a conventional 30-year fixed rate. Actually, let me get it. I got to zoom this in. Here we go. 30-year fixed rate, conforming mortgage with a loan to value less than or equal to 80, meaning you put a 20% down payment, at least the borrower has at least 20% equity in the property. Mind you, we've also got very highly valued properties. That's a conversation for a different time. And then FICO score greater than 740. So these are prime borrowers. In other words, this is the lowest rate that you get for a traditional conventional mortgage. And we're sitting right now at 6.24. We'll be lucky to get below 5.8. Okay. And you can see that we've got higher lows here. We also, yes, technically short term, we've got lower highs. But I see this coming up to the blue line before it comes down to the red line. Okay. Now, just for sake of comparison, on the jumbo side of the world, okay, here's a 30-year fixed rate jumbo. Okay. I do see some intersection here, somewhere around 6.2, 6.5 between now and the end of May. Possible, but this could stretch. Don't worry about what these lines are. I mean, that's just right now where two trends are converging. But I would say that, again, we're likely to come up to the blue line before we come down to the red line down here. And this is actually the 6% mark. Okay. we're trending back upward. All right, so don't get your hopes up too high on the long end of the spectrum. It's the short end that'll potentially have a bit of a cut. So maybe some car loans will come down from that 9 and 10 range, down into to maybe 6 or 7 range. But you got to be ready because it's going to be a short burst because of the inflation problem. All right, so that's that. I know this is a long talk. I'm trying to jam a whole lot into this because there is a lot happening right now. I will quickly highlight global versus, and actually let me double check my notes real fast. I've got some nice handy notes here just to be sure I'm hitting everything that I say. Before I jump into this, I'm sorry I didn't want to go to global markets quite yet. I wanted to quickly highlight something else in the lending space. Here, as we talk about inflation, here's a good inflation indicator that I use. Okay, this is TIPS, so Treasury Inflation Protected Securities versus IEF. These are both exchange traded funds, so it shows me kind of what the market's buying and selling. It's not just an index, but it also, the IEF is a 7 to 10 year, if I'm not mistaken, 7 to 10, or is it 5 to 7? It's somewhere between the 5 to 10 year Treasury note. And what we're looking at here is, are investors positioning more into 5 to 7 years? So TIPS, for rule of thumb, kind of think of them as 5-year Treasury inflation protected securities. That's not exclusively what they are, but kind of ballpark it. So are investors looking for the potential return that you'd get from a longer dated, so 5 to 10 year Treasury note, or are they looking for the inflation protection? When this is going down, they care more about the coupon on the Treasury bond or what the Treasury bond represents in terms of safety or whatever. When this is going up and to the right, kind of here, that means they are protecting against inflation. This is a very aggressive run up, and it happens that we're in now double tapping in the range of the 2010 and 2022 topping range for this relationship. So this relationship, you can see here back in 2022, this was the all-time kind of peak for the recent cycle. And then dating all the way back into 2010, you can see here that we reached this, and this is coming out of 2008 and 9. We had a lot of stimulatory, but the market here realized that the stimulatory measures taken by the Fed, while systemically, broadly speaking, the Fed had a huge shift. They went from they basically moved to an excess reserve policy from a finite reserve policy. So this is where the money printing, ad infinitum or in infinitum, whatever that term is, the Latin term. This is where the systemic policy adjustment happened. But here, short term, this run up here, all of a sudden the market went, wait a minute. Oh, they're not pumping money into the market. They're just simply pumping it into the banks, and the banks are giving it back to the Fed. So it never actually gets into circulation, never gets into the M2 money supply. Okay, so then all of a sudden things cooled off. They came back up and touched again because we got all these secondary stimulatory programs that came into place. Cash for clunkers, the buyouts, GM. So many other factors. Okay, but we got this second touch into this territory. And mind you, way up here, right? This is June of 08, but we were living in a different paradigm. Okay, then so TIPS played a different role in history, and ETFs were fairly new. So let's just kind of exempt this relationship, this pricing back here, and let's kind of look at it as a post 2008 forward indicator. This is okay. So the fear of inflation was here. The fear severely abated, but then it started to pick back up in 2016. We had some reverse repo, and I don't want to get into all the mechanisms of, again, how the Fed works and how the banking systems work. There was more fear of inflation coming back in. Okay, mind you, this is when, remember what happened in 2016? That was Trump's first election. Okay. This was also Brexit in the summer of 2016. So don't get caught in the weeds on that, but a lot was happening. 2015, some things happened with China, moving on. And then all of a sudden we get 2018, right? We have this real big fall off. We have the Christmas crash of 2018 here. That was this precipitous decline. Those were midterm elections. That was the blue wave is going to take over. That was, again, the reverse repo lending crisis, where the secondary emergency window was opened and there was basically a liquidity crisis. And then, look, all of a sudden the inflation fears really taper off with an extreme COVID and then extreme rebound, right? So this is basically, this line just tells a story. The question is, what are the details that I'm filling in for you? But here we are. And then, oh, look, everything's fine again until it's not. And we have this nice upward trajectory starting basically in January of 23. Silicon Valley Bank failure. Okay, are we going to have another banking crisis? Moving up, AI takes a breath. The story continues. August of 24, that's where we kind of had the slowing in the AI space, regulatory problems, whatever else it might be. Big robust burst, tariff tantrum, and then last of all, the war spike. But the thing is, the trend is upward trajectory. The inflation problem is here. It's not going away. All right. Now, to counter this, let's look at another indicator for the fixed income world, because at the end of the day, the lending markets, the fixed income markets, they are way bigger than the equity markets. Whether they should be or not, again, leave that out, okay? Just know that they are, and know that they are long-term in nature. Lending is a long-term concept. Equity buyers can buy and sell because they think somebody's got a good idea today and they change their idea tomorrow. If you're going to lend to somebody for a fixed period of time, you've got to be long-term in nature, even if it's just 1 year, because you're committed to that loan if you want to get your full principal plus the coupon or the interest rate. Okay. This is high yield, or what we call credit, versus IEI. So just to let me clarify, IEI is the 3 to 7 year, IEF is the 7 to 10 year. So when we were looking at tip to IEF, that's 7 to 10 year, like I had suggested. IEI, a little bit shorter term. So this is 3 to 7 year treasuries. And this is basically saying, it's not so much, do I want to be in inflation protection or do I want to be in government treasury? This is more, do I want to be out lending to really bad borrowers on paper, meaning I've got a high risk that they're not going to pay me back, but I get to charge them higher interest rate. Do I want to be out there, or do I want to be in government where I get a lower rate, but it's safe because the federal US government will always pay me back? Maybe. But the point is you'll note here that there's still a decent appetite for the high yield or the credit, the bad borrowers. There's still a decent appetite. But this big long trend here, this blue line, that's a big one. I don't see us getting above that. Even the smaller, shorter term trend peaking off here in January of 25. Okay, you're noticing that the risk appetite in the fixed income world is declining. Okay, why would it do that? Well, if rates go up, bond prices go down. Okay, so that could be one reason, maybe because the market is sniffing out, maybe rates are going to go up, or maybe it's economic conditions aren't so robust. I don't want to lend to the bottom of the barrel. I want to lend to the premium borrowers, the AAA, the triple Bs. Okay. Regardless, though, we're seeing longer term a trend down. Short term, though, there's still good risk appetite. It might be topping, though. So that might be put in the column of bearish signals, if you will. Okay, let's finish the conversation around rates with one last chart that I do think we need to look at. And that is our, broadly speaking, a best representation of what the financials as a whole are doing. At the end of the day, economic expansion needs financials to be successful. The banks have to be doing okay for economic expansion, because at the end of the day, those that have great new ideas need to borrow to get those ideas to market. It's just kind of where we are. Okay. If the banks are struggling, they're not lending. And if they're not lending, we're not expanding. That's kind of your short story. It's more complex than that, but that's how I can wrap it up in a nice bow. All right. You can see here, this is the pre-GFC high in the financials. Now, if I were to adjust this for inflation, And the best way that I can do that, as I've done with oil multiple times, and you've seen me do this, is I can divide this by gold, because gold doesn't change in price. The dollar does. The dollar changes in value. Gold is just what it is. It's not worth more or worth less. It's just worth gold, because there's only so much of it. You can't create it reasonably. You can't really destroy it. Yeah, you can throw it in a pot with mercury and that'll change it, but it'll change back. But the point is notice XLF priced in gold is not doing so well. Let's zoom it out to as far back as we got back in the 90s. Okay, look at the last time we were down here, March of 2009, August 2011. We're all the way down here. We got back up to here, but we're never, the financials didn't recover all the way. But let's assume, okay, maybe that's not a fair comparison. Maybe that's not appropriate, right? Inflation adjusted pricing, maybe that's not the right thing to do. Instead, let's see what's XLF doing as relates to the S&P 500. Let's find out. Oh, boy, that's interesting. Look at that. We're below the 2020 lows. We're below the 2009 lows. Going all the way back to 1999. Now, what do you make of that? Well, you can make a couple things of that. One, the S&P is just doing that fantastic. Two, the S&P does not have a lot of financials as a part of its constituents, at least not the weighting. JP Morgan's basically the only one that contends in the top 15. Maybe Berkshire Hathaway, if you want to kind of consider that a financial. I mean, it is, it's not, it is, I don't know. But it's not like Citigroup and some of the others that used to be a large representation. The S&P 500 is so dominated by tech, okay? But this matters. This is not a positive thing. I don't want to see XLF financials struggling. I want to see them turn back up, because if they're struggling, the markets are going to struggle. That's just what happens. We can kind of let's isolate this and let's show, or not isolate it, but let's kind of put a little bit of a cap on this, and let's just throw the S&P on here, and you're going to see, look at these fall offs, right? XLF, that's 20. Okay, let's come back here. All right, so here, I'm sorry, we need to change different color here. All right, red's the S&P 500, and then that relationship of XLF priced in the S&P 500, so we can see we kind of had a peak here in 13, trending down. All right, the S&P was fine, but in 2015 through 2016, it had a rough shake, right? Not a good market here. And that was, kind of right before this big fall off. Going back here, we can see declining. Everything's fine until it's not. There's a fall off. So the moral of the story here is, if financials don't turn around, that's where the bad signal comes in. I want to see financials turn around. That's what we want to see. Regional banks, okay, they're very much in this upward trajectory from that Silicon Valley Bank failure. Okay, they're doing pretty nicely. All right, but it's not even fair to compare them to the S&P. I mean, look at this. Ever since that Silicon Valley Bank blow up, they haven't made any headwind whatsoever. So it's not like we're talking about incredible robust strength here. We need to see financials get it together. We need to see banks get it together. Now, if rates go down, banks will do pretty okay, because they're going to have more lending demand. More borrowers will come to the table. If rates go up, not so good for them. Okay, so that's kind of the moral of the story on that one. We will see. Last but not least, okay, let me hit these charts and then I'll talk about portfolio changes. But I've dragged on enough. The China and the interest rate decisions, Kevin Warsh, that's the real moral of the story as we look at the next, let's say, quarter to 6 to 10 months down the road. Those are the big ones, and I had to spend time on those. But if I'm going to look at the FTSE Global, all cap, XUS. Hey, look at that. New all-time high. We've dipped back down. That's fine. That's fine. I'm okay with that. Okay. What I really care about, though, is let's take this and let's divide it by the Russell 1000. Okay. So we're not going to take the top 500 stocks in size for the US. We're going to take the top 1,000 stocks in size by the US. And let's see what we look like. Well, boy, oh boy. Isn't that something? If I were to be able to, because these ETFs didn't exist prior to this start date, if I were to take it back, you would actually see a really robust uptrend in international from about 2002 to 2007. International drastically outperformed the United States. Okay, but since again the shift from a finite reserve to an excess reserve policy, the fact that Europe and the greater developed international markets tended towards austerity versus the US that tended toward accommodation post 2008. Okay, the US has been in this massive expansionary cycle as far as our markets are concerned. We did see the fall off here. Again, this is that 2016, 2015, 2016 period. We got that flattening out, but then we trended back down. And then we got the 2022, right? International really leapt off, but it came back down. Now we started positioning into international way back here. We are now overweight international because we have hit a big pivot point. The fact that we're coming up to this particular retracement here, I'd like to see us break through it. Of course, it's going to take some work, but we are working our way up. Now, this could be discontinued, this trend back up. But until it does discontinue, the reality is that right now international is actually the stronger market to the United States. You just have to be very picky with where you are internationally. So for that reason, as you'll find out in just a moment, the portfolio change that we've made, the adjustments in the portfolio, we are now officially overweight international to domestic equity. That's the first major overweight that we've had. We were edging into it at the start of the year. Now we're officially there. So those of you who are not clients, I'm going to cut off the public facing video here. Those of you who are, hang with me. We're going to jump into the portfolio changes quickly.